From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for December 12th, 2025. The next home game for your Milwaukee Bucks is Thursday when they jump it up with the Toronto Raptors. This weekend, the Milwaukee Symphony Orchestra is doing their holiday pops. So if you ever wanted to sing along with the symphony and not get thrown out, this is your chance. Monday and Tuesday night from 5:30 to 9, the Milwaukee County Zoo and the animals will be lit up with hundreds of thousands of holiday lights. Hopefully the lights throw off a little heat. Here's a tip. If you're going to steal a Fabergé egg, don't do it this way. A man walked into a jewelry store in New Zealand and asked to see their Fabergé egg locket. It's 18-karat gold, white diamonds, blue sapphires, and a mini octopus with 2 black diamonds for eyes. The thief picked it up and swallowed it. He was arrested immediately and taken to jail, where cameras and cops monitored his every move and movement. After 6 days, the locket was recovered. A wax museum in Texas had to pull its Donald Trump statue from public view after repeated incidents where visitors continually kicked and hit it. President Trump always says his bad poll numbers are fake news, while a wax museum in San Antonio might disagree. And finally, if you remember 2 weeks ago, Kim Kardashian was complaining that this ChatGPT was to blame for her failing the California bar exam. Now she's mad at her psychics. The same psychics who told her she would pass the bar exam are now saying she has low brain activity. But their psychics shouldn't they have known that? On the podcast today, we have Steve Giles, Tom Pappenfus, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A mixed week overall. The NASDAQ down 1.6%. The S&P down 0.6%. But the Dow up 1 on the week. Signs that maybe we've seen some transition into some new stocks on the year. NASDAQ up 20.8%, including dividends. The S&P up 17.4%, including dividends. And the Dow up 15.6%. Tom, maybe the place to start is just to look at the week and numbers. Encouraging, I guess, that on a Thursday in which we saw some pretty significant decline in the stocks like Oracle, kind of the key players in the artificial intelligence space, the S&P pushed to new all-time high close. We saw, I think, some new participation potentially, and I know you've talked quite a bit on prior podcasts about how important breadth can be to market rallies and what it really tells us as investors. I wonder what we learn in a week in which, maybe the S&P was down, but we did see some, I think, new participation in the rally.
Yeah, I think you're definitely seeing investors recognize and start to hunt out performance. I mean, the idea, I think, of rotation is kind of just starting to build right now, moving away from really more expensive stocks, areas that have dominated and led in returns, as well as attracting more investor dollars to areas that are have been less attractive at this point. And I think some of the luster of the AI is can wear off at times when there are some, let's say, I think we have a lot of mixed data out there. And so I think we get to a period of time where we've seen the gains that we have this year, and looking at valuations, and investors are saying they're looking for more attractive potential returns. And so I think that's part of some of the resilience that we are seeing in other areas of the market, that you'll start to see other sectors start to take off.
Well, and it's not just domestic, Tom. Look at what international has continued to do this year. One of the better performing asset classes. A good reminder that asset allocation is more than just value or growth, large cap or small cap. It also encompasses sometimes going outside our borders.
I think that's a very fair point, Steve, and probably a good opportunity with where we are in the kind of the seasonality of markets to talk about earnings, really bring it back to kind of the basics. Steve, it's all about earnings and interest rates. It was another great quarter for earnings. And as we look at maybe a market that many have felt has gotten ahead of itself in many ways, worth pointing out that because of how strong the earnings growth has been and how strong those forecasts are, stocks don't look quite as expensive as maybe they otherwise would because, again, get back to those basics. It's all about earnings and interest rates.
Yeah, when earnings grow at 15% in the third quarter here, that's nearly double what we saw in terms of forecasts from the beginning, 8% in January. The idea that even though the market continues to set new all-time highs, it's being supported by these strong earnings numbers from companies, which is, for all intents and purposes, a good thing.
I would say that anytime you have earnings growth, you have a reason to be optimistic about stocks. And the challenge is always that so often we are talking about expectations, right? So often we were talking about where things are headed. The fear was that a lot of those earnings expectations were founded on the back of AI spending or technology spending more broadly. And the reality is we've seen that earnings growth in more areas than just tech. It really has been broad-based earnings growth. And interesting, Tom, especially the conversation around AI spending has shifted now from just, well, the businesses that are doing all the build-out are the ones that are going to make all the money to, hey, maybe we see some margin growth, maybe we see some profitability growth from those businesses now that learn how to use AI to really drive their ability to be more productive going forward.
Yeah, I think what's going to be really exciting to see is just kind of that transition, that evolution of the companies that start to see the biggest gains. Again, right now it's the ones that everyone knows about, the producers of AI, the ones, the companies with the deepest pockets. But the next level to all of this is who begins to adopt it, implement it, and to your point, enhance those margins. And I think that's going to become a far more attractive area. And those could also be, value companies categorized as value relative to growth. And you start to see some of the, the exponential earnings growth of some of these larger companies is likely to start slowing down. It can't continue at the pace that it has, but you're looking at the value category of companies. They had earnings growth last year of about 2%. It's going to be this year about 8%, 10% for next year. So we are starting to see, the other side of this trade start to come to light, and you could start to hunt out companies that may benefit that aren't traditional technology companies, but they might be, areas in industrials, companies in industrials. I think you and I have talked in the past about John Deere is really not about, let's say, an industrials, equipment manufacturer. They're a huge technology company with how they use technology to, drive these large equipment and machinery. So it's really fascinating to see kind of who comes out, and I tell a lot of clients that we don't really know who these companies are, who's going to be the first to find the best and most profitable use for AI.
Tom, wasn't it John Deere that in years past, I think the most few years they've been hiring more software engineers than they have mechanical engineers?
Yeah.
Because of this need for technological advancements that they're building into their machinery.
And I think one of the things we have seen is, John Deere's got deep enough pockets that they can invest in those software engineers, but there has been a democratization now of access to this technology. And so if you're a plumber with, one or two other employees, the challenge you always had was to get the next job, you had to pick up the phone. To get paid for the last job, you had to send the invoice. And now you've got likely some software that can schedule an appointment for you, that can send out your invoices, that can make sure you get paid. And so if that was 15 minutes of your day that you weren't spending plumbing or running electrical or whatever it is your job was, well, all of a sudden, all these skilled trades are becoming that much more productive. They're doing what they're actually trained to do instead of spending their time maintaining their business. And so when we really think long term about what's the impact of some of this technological shift, it's not strictly how does Caterpillar or John Deere benefit from making their production lines more efficient or from making that tractor, that much more technologically savvy, but how do we get it all the way down to those small businesses that maybe historically didn't have great access to the latest and greatest technology, but to make them more productive, because we do have a gap, we do have a shortage of skilled labor in our country. Well, one of the easy ways to solve that problem is just to give the plumber more time to actually do the plumbing work instead of having them spend their time doing all the business maintenance. And so I think that's a big part of this story as well. In part, it's why we've seen so many plumbing shops picked up by private equity firms. They see that with a little bit of cash investment, they can turn these into very efficient cash powerhouses. And so I think really it is a big part of the transition as we look into next year. It's not just big names anymore. Now a lot of businesses start to figure out, how do we grow? How do we become more efficient? Yeah, maybe cut headcount a little bit, right? And reduce some of the expense side of the balance sheet, but you're going to generate revenue that way as well. And so I think there is this immense shift coming from this technology with a lot of pain along the way, a lot of hurdles to cross. But that said, I am ever the techno-optimist, ever the one that believes that technology will solve a lot of the problems that we know are out there. Some good profits, some good revenues, some good earnings for shareholders to be had from solving those problems as they come.
You know, I can vouch, Kyle, for having experienced a robot answering service, and if I didn't know any better, it was as though I was talking to a real person. It was that realistic, and the only thing that keyed me off was that when they picked up the call, I was alerted by my phone that this could be an artificial intelligence system answering.
Even our phones are smart enough to know now. And eventually we'll probably have to count on them to tell us when we aren't talking to a real person. So I think it's such a great kind of insight into what's out there and what's coming. And then amidst all this, we had the Fed meet Tuesday, Wednesday. We got an announcement middle of the day Wednesday that the Federal Reserve was going to be cutting interest rates, the overnight lending rate specifically, 0.25%. And I think we all more or less saw it coming. I'm interested, Tom, especially in what came out of that conversation. Jay Powell in particular pointing to 3 dissenting votes, very atypical of a Fed vote that you get even one dissent, let alone multiples and in different directions. Jay Powell kind of pointing out that he maybe doesn't envy the position that the next Fed leader is going to be in, because it is getting more difficult to set policy when you don't have all of the Fed voting members on board.
Yeah, I mean, I think right now especially, we're very much continue to be in an environment of mixed data. You know, on one hand, the fundamentals we talk about, company earnings look great, GDP growth looks great. At the same time, we do have a weakening labor markets. We continually get payroll numbers that are underwhelming, to put it mildly. And we get, we're looking at consumer, soft data through consumer sentiment surveys, which are incredibly low. People just don't feel good about the environment. People aren't excited, aren't optimistic that they may find a job right now. And so you're again kind of in a tough position of marrying, well, on the surface things look pretty good, but then you have all these other numbers and metrics that put them in a position of, well, how do we balance this? And we're looking at inflation that continues to slowly drift up, and a lot of the, impact that tariffs may continue to have, that it sounds like a lot of the prices haven't fully reflected the tariff, the cost yet. And so some of the anticipation could be that inflation continues to rise. So how do you marry, good, solid growth numbers with, some weakening numbers at the same time? And so to your point, that puts anybody in a tough position.
And Tom, that's a good point, because we were talking about this before, but there's still a disconnect, which we've had for more than a year now, between how good the economy is actually by the numbers and how good people feel about the economy. And we say this all the time, that a lot of times people don't do what they feel. They feel bad about the economy, and still we've got record numbers for holiday shopping this year. So when you're trying to work with that, and for the Fed's work, they're relying on data. So they're trying to look at numbers which are, we're just sporadically getting caught up with some of the numbers that hadn't been collected in the 43-day federal government shutdown, and they're trying to balance that against what people are griping about.
Well, this is somewhat anecdotal, Joel, but I've had plenty of conversations with people who recognize that things are more expensive. They complain about the inflation component, and they know that they're paying more for something than they did, say, a year ago, but they have this fear that if they don't buy it now, it'll be even more expensive later.
Yeah, we call those negative feedback loops, right? This idea that if you have a concern that prices are going to rise, you buy now because you know it'll be more expensive later, or at least you think you know. And if you have this concern that prices are going to fall, well, you wait, and lo and behold, prices fall because we got to attract more buyers. And so we've talked about this a lot historically. One of the big things we pointed to was what we tend to see in countries like Japan, where inflation had been so low for so long. We eventually got these negative interest rates, and then the expectation became that, this is where we're going to be for a while. and it caused even more of that. And so I think at times it can become this self-fulfilling prophecy. Add in, I think that we don't have policies right now that have been terribly effective, at least so far, at solving those problems. And so I think consumers are rightfully looking at that and going, well, okay, we're just going to keep spending because we can right now. That's the good news. They can. The bad news is we're going to keep spending because we are concerned that prices keep going up.
And, especially with the tariffs, I mean, we hear from a lot of businesses who say, if only I knew exactly what those tariffs are going to be, I can deal with them because I'm a business person and I can plan things out. But that level of uncertainty that's there is just hard to deal with.
And I think when you look at what it means for the Fed, now not only are we dealing with those uncertainties, but we are dealing with an incoming president of the Federal Reserve that may have a different way of talking about those issues. And so as a market and as investors, we're going to have to really now rethink how are we reading between the tea leaves, right? How are we understanding what the Fed is saying? Because it isn't going to be messaged perhaps the same way that it was with Jay Powell. It'll be, probably early next year in which we nominate a new Fed president. It'll be shortly thereafter that we likely approve whoever it is nominated. And again, then the conversation begins to shift. And so I am interested in where we settle, in part from an individual, right? Who do we pick for that role? But I'm even more interested now in how do they talk about these very same things that Jay Powell and the Fed have been talking about for so long, because the message is going to be different. And even if they're saying the same things, sometimes the way they get there might change how the market responds. Joel, beyond kind of the typical inflation data, which we've been looking at, not much new there. Not a ton of economic data this week, but in particular, a couple things that stand out to me. The big one is that trade deficit number, which certainly has been in focus for much of the start of this year.
And it's very volatile because of the uncertainty with the tariffs. And the beginning of the year, in anticipation of the tariffs, a lot of businesses that could bought a lot of imports so that they could avoid paying those tariffs, those higher taxes on them. And it's still unsettling as to what the effects of this is. And then with the tariff rates themselves fluctuating, it's really kind of hard to tell. So we got numbers this week on the trade deficit for September, and it was the lowest deficit since the pandemic, since June of 2020. So 5 years, it hasn't been that low. At the same time, remember that earlier this year in March, we had the biggest deficit on record. It was 2.5 times bigger than what that low deficit was in September. So it's hard to tell where that's all going to even out. We also had numbers this week on job openings, and that's showing us that although they're still above where we were before the pandemic, that there's still greater demand for workers now than there was back in 2020, that it's down 37% from the peak back in 2022. One of the things that I look at in those job opening numbers is a number that they call quits, and it's basically measuring the confidence workers have in quitting the job that they have because they figure they'll be able to find something else. That's been below the pre-pandemic level now for 2 years. So that's a sign that, again, getting back to Tom's thoughts on the sentiment, that people aren't feeling as confident about the economy.
And understandably so. Certainly, I think we had some easier years. Looking back to the recovery from the pandemic, a lot of cash out there, a lot of people that had pent-up demand for things, and now that some of that cash has been spent and some of the maybe easier days are behind us, well, it is a bit natural that maybe we'd be a little bit more pessimistic about where things are. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.